Good morning, everyone. Welcome to the new week and the macro snapshot. We are Monday, the June the 9th, 2025, recording this in the morning, of course. Okay, not a huge amount going on today in terms of data. What we do have is over in London, we have US-China talks. Treasury Secretary Bessent is there. Trump has already tweeted out that talks are very far advanced. So Trump is putting a positive spin on things. There's been also a couple of bits of news that the Chinese have released a few export licenses for rare earths, and that seems to be one of the big sticking points. So let's see what happens there. The market is in quite a good mood. There's quite a bit of sort of relative mild risk-on sentiment this morning. So the market, I think, has relatively strong expectations that there will be some good, some sort of positive news and some sort of good sound bites, if nothing else, coming out of London. Although, as always with these things, we need to see what the US says. They'll probably sort of talk it up and Trump will tweet. On the other hand, normally China is a bit more sober in their sort of communication. So it's probably more interesting to actually sort of see what the Chinese say, but hey, they're meeting and the market has, a positive outlook on that. One thing also, which is interesting, Trump is starting to tweet and sort of put about this idea of sort of nominating and releasing the name of his nominee for the Fed chair sort of much earlier than is sort of historically normal. We know that Powell has about another 12 months to run on his term, and so if Trump were to sort of, for example, nominate publicly someone like Kevin Warsh, that's going to create a very awkward dynamic for the market and for the Fed itself to have, let's say, a shadow sort of Fed chairperson who's sort of prognosticating on the economy, and maybe Powell is saying something different. So that's kind of interesting to look at. And of course, the other big thing this week, we do have the CPI, which is going to be pretty important. Okay, so let's just have a quick look back at the data on sort of Friday. So we obviously had the payrolls numbers, the non-farm payrolls, which I'll just bring up. Just grab a little bit of tea here. The market took this as a positive. If you actually see here, the survey was for 126, although the whisper number was probably a bit lower, sort of 100 or 110,000 or so. So the whisper number was a little bit lower, but nonetheless, it did come in at 139. And the market kind of, the front end of the yield curve sold off. The stocks sort of rallied and the US dollar rallied a little bit, not a huge amount, a little bit. So overall, the market took this as a positive thing. But the reality is that if you look at this going back, this is not a great number. It's just, sort of barely sort of ticking over and just it's not evidence really of a strong market. On the other hand, it's not collapsing. Now, the other thing as well, if you look where the jobs were created, they were created in healthcare, leisure, and hospitality in state and local government. So, that's all very well and good. But what we're not getting here is, like construction jobs or, manufacturing, professional and business, natural resources. So a lot of these things are very, very flat, much more in the sort of the low wage kind of services sector like leisure, hospitality, healthcare, and social assistance. So interesting, just keep an eye on that. You look at healthcare again, that's the main sort of engine of driver here. Also, we're seeing a little bit for leisure and hospitality, a little bit positive. Unemployment rate still remains at 4.2, so that's pretty good. The Fed will be happy with that. But the problem here, the participation rate was down. The problem here for the Fed is that the average hourly earnings is still at sort of 3.9, which is actually a little bit higher than expected. So that's going to put a bit more pressure on the Fed, just because inflation seems to be sticky. It's these kind of sort of numbers are not going down, and we know the input prices are not going down. But overall, the market took that as pretty much as a positive. So just in terms of also this week, we also have the bond auctions this week. We have threes, tens, and 30s. And it's just going to be interesting because some people are saying, a lot of the commentators are saying that the CPI actually might come in a little bit softer this week. We'll see what happens. And despite those auctions, who knows, we could have the yield sort of pulling back. So the CPI is going to be super, super important. But let's just look at a couple of charts here and see what's going on. If we look at actually, I need to go back here. Let's just start with the US yield. So you can see here that there was a huge run up in the 2-year yields here. And just before we look at that, actually, I just want to see what happened in the Fed. So just in the back of that, sort of higher than expected number, you can see here that the pricing for December is now down to 1.8 cuts, so less than 2 cuts. Now, keep in mind that the dot plot is signaling from the Fed two cuts for by the end of 2025. Now we do have the meeting coming up on the 18th, and you can see here that the 18th is absolutely zero, possibility of a cut according to the market. And then as we go further out in the year, the first cut's not priced in until late October, and then almost to going out to December. But that took a big hit there, and you can see that if you look just at the intraday chart here. This is on the tick chart. So this is pricing for December 25, and you can see this number of basis points. So 50 basis points would be two cuts, and you can see here that on the news of the non-farm payrolls, you can see here that we went from about 54, we got up to about 44. So 10 basis points, almost half a cut was fully priced out. That's about 20 ticks on the STIRs on the short-term interest rates like SOFRs and Fed Fund futures. So that was a pretty dramatic move at the front end of the curve there, and you can see that also just in the SOFR curve itself, which I'll just bring up here. So you can see the live data is where we are now in the white, and you can see that that shifted all across the different tenors. That's actually shifted upwards, and you can see that this is going back about a week or so. You can see that the orange line here, let's say where we've gone up about 10 to 12 basis points, sort of going into 2026. So definitely a sort of a hawkish repricing there, and essentially the market's saying, well, okay, the economy is not doing that badly, and certainly the labor market. But that gets us to an interesting point, because we do have the Fed, as I said, coming up in 9 days or so. And the question is, will they change the dot plots, so their future sort of projections, and take it down from two cuts, which would be very hawkish, down to one? Or will they just leave it there and say, hey, that's still what we expect? So because I don't expect them to change it too much, and we do have a Fed funds rate at 4.33, I really think that, something we're getting up around to levels here where the 2-year probably doesn't want to go too much higher. I mean, we could push up, let's say, to 415 or something like that, 412, 414, something up there. But I think anywhere up there is probably going to be, for the time being, in the absence of radically sort of strong data or crazy inflation. I think something up around about 415 on the 2-year yield would be actually probably a little bit of support here. It would be interesting to buy some call spreads or something. If you go out then, let's say, onto the 5, similar kind of situation that moved up a lot on Friday's data. And I'm thinking something, around about sort of up here at around about 4, maybe up at about 421, 422, something like that, would probably again be some kind of sort of support level there for the 5-year. For the 10-year, if we go out there, you're looking maybe a little bit higher, maybe up to about 4.6, something like that. Again, there's a bit more room to go up there. So the point is here is that the front end has moved quite a lot. And I think, as we get close to sort of general collateral and the Fed funds rate, which is around about 4.3, there's probably not that much more room to go. We're at sort of, a level now where the market is probably going to be comfortable in the absence of, other data. What is interesting, if we look at some of the yield curves and we look at something, let's say, like the 2s, 5s, you can see here that, basically, except for Friday, that was a fairly, range-bound kind of week. But on the other hand, if we get a sort of a weak CPI on Wednesday, I think this could steepen quite a lot, as those front end 2 years have to start retracing a little bit, and at least pricing in maybe 2 cuts or even 2.5 cuts. And that could definitely steepen here. I mean, who knows, maybe up to even like this plus 15 basis points or so. So that's definitely something to be looking out for. And it looks as though it's sort of bottoming here. So that's one I'll be keeping an eye out for, is the US 2s to 5s. The other thing is, if we just shift across to Europe, let's just bring up, let's say, the 2-year yield. Now, obviously, we had the ECB last Thursday. They cut, and Lagarde made a couple of comments, essentially saying that they were getting to the end of their cutting cycle. And a lot of ECB speakers since then, in the last 2 or 3 days, have essentially said that that's enough for the time being. And so we could say that the ECB probably, there's still one more cut priced in until the end of the year, but probably in the absence of sort of much higher inflation or very, very strong data or something, we can expect the ECB maybe not to cut too much more. And to be honest, the ECB did revise downwards their inflation numbers. They're now down below 2%. So it seems like a good chance that the ECB has done the hard work. They've cut quite a lot, much more than the Fed, I should say, and that they won't do too much more. So if we believe that, we think that the ECB is maybe on hold for, probably 1, 2, 3 months or so. We can expect here maybe the shots. This is the 2-year yield. Maybe that's going to be more or less kind of range bound here just at the moment. Obviously, it went up on the Thursday on the ECB, but probably it's just going to be in a bit of a range here. If we look at something like the 10-year, you can see here that it's finding it very difficult to get below this 2.5%. And that's just because we've got the spending bills coming in. I think next week there's more sort of spending bills going to be ratified in the German parliament. And basically, you've got the infrastructure spending and Germany, the real yield. The problem is the real yield in Germany. In the US, the real yield is well over 2% on the 10-year. So you can invest in US bonds, and after inflation, even with the sticky inflation, still get a reasonable return, even almost up to 3% on the 30-year, and on the 10-year, it's about 2.5, I think about 2.6%. I'll have to check on the real yield in the US. But if you go into Germany here, you can see here that the real yield are only about 50 or 60 basis points, because the 10-year yield here is only 2.5. Now compare that to the US, where you've got about 4.5 approximately. So the point I'm trying to make here is that it seems to me that both because of infrastructure spending, defense spending, but also the fact that the global market is going to demand more yield, it seems to me that this 2.5% on the German 10-year is probably some kind of base. And that if anything, it's probably more normal for that to actually creep upwards, maybe 2.65, 2.7. Now, if we believe that the front of the German curve, the Schatz, the 2-year, is more or less going to be sort of range bound because the ECB has done its job, then probably what we're going to be getting here is something like, some kind of steepener. And we'll see here, let's have a look at do I have the German curve here? So if we look at, let's say, the German 2s to 10s, you can see that it's actually flattened a bit, but I do believe that that's an interesting one to look at, and that could possibly start steepening a little bit. If we look at the 2s, 30s in Germany as well, we see how that's flattened. That could be something interesting to look at as a steepener over the next few weeks or even months. What's also kind of interesting here is that, as I said, if the real yield in Germany doesn't sort of go up too much more, that's going to make it much more interesting for sort of allocators if they want to get out of the US. To start looking at things like the French and the Italian bonds. And if we actually look again at the French bond here, you can see that's yielding 3.2. And if you look over at the Italian yields, which actually, where's my spread here? I have to go up here. If you look at the Italian bonds, they've been doing pretty well. And you can see here that the Italian is getting you 3.5. So you get a 1% pickup here over the German. And you can see here in the yield curve here between the Italian and the German, it's almost at historical lows. We have to go back a long time to get to this level here of just about 93 basis points. We're really getting to points where we haven't been for quite a long time. And so basically, it seems that investors, if they don't want to be in the US or they want to be allocating to Europe, they're preferring the pickup, the yield pickup, which they're getting with the Italian bonds. So it looks as though any kind of rally here up to 1%, 105 or something is being hit and is being pushed down again. So that could actually go down if we put it on a weekly, just to get some historical perspective here on the Italian-German bond yield here. You see, we're getting to quite interesting points where we haven't been for a long, long time. We'd have to go back to 2021 or then back to 2016. And what could happen here is that we might just test a little bit lower. I mean, who knows, down to about 75, 80 basis points here. Maybe just stop out a few people at sort of 65. But I think something like about, 65, 68 basis points here could be interesting to go the other way. We're not there yet, but that's definitely something to be looking out for. And so what's interesting here as well is to start looking at just the differentials here between the US and Germany. So, for example, if we keep in mind, let me just go back to the yields. If we keep in mind this idea that I'm just going to put up here the US 2-year minus the German 2-year, and the point I'm trying to make is that inflation has come down a lot in Europe. It's possible that despite the tariffs, this might slowly attenuate in the US as well. And with this lack of sort of yield pickup in the German curve, it could be that certain sort of allocators want to start reallocating money a little bit back into US bonds, or at least are not shy about doing that. And just also because, if the Fed starts to cut. And so if that's going to be the case, it could be that something like this US 2 year minus the German 2 year, I mean, it could drift a little bit higher. We just have to see what shakes out over the next few weeks with the tariffs and whatnot. But I would say that once, it's going to be difficult to get over, let's say, this 2.25, 2.3 level. And then I would expect this over time to actually come back down. I mean, who knows? It could, come back down to 2% or even 1.8, something like that, come down quite a lot, just as, the front end of the curve in Germany remains very flat, and the US 2 year yields start to come down a little bit. So that's something interesting. And a similar kind of situation here, if we look at the US 10 year minus the German 10 year, for sure it's been going up, but it seems to be finding a little bit of resistance here around about the 1.97, 2% mark. And again, if we do start getting some stability in the US inflation numbers, and there's hints that the Fed might start cutting, and the tariffs, we might start getting some deals and the tariffs won't be as onerous, it wouldn't surprise me at all to see this spread come back down in, 10, 15, 20 basis points as well. So that's something to be looking at. Okay, grab some more tea. Now, if we look at the US dollar, I'm going to put it on the dollar index. Obviously, it kind of bounced up. Now, this to me looks like a bit of a basing formation. It's a tricky one technically, or it's an interesting one, because if you could do sort of a Fibonacci sort of extended measured move here, and you could say that the measured move is definitely, there's more downside. So we could have some kind of sort of extension here, just break some stops and get down to, 97 or 96. That's absolutely possible from a technical perspective. On the other hand, you could just say that, why the trade deals are being worked out, and we do just have negotiations as we get into the slightly slower kind of summer period. You could say that here we're just getting into some kind of basing formation here, and the US dollar, rather than sort of collapsing or actually ripping, might just sort of be trading in some kind of range. You can see here on Friday that it had a little bit of a boost on the job numbers, the employment report, which was positively received. But you can see already this morning that's just giving it up just a little bit. But it does seem that at the moment there is a little bit of support around here, about 98 and a half. And it wouldn't surprise me if we have a fairly quiet trade range. Again, this is going to be dependent on CPI. If we get a soft CPI, for sure, this could go a little bit lower and retest down to 97.7. On the other hand, a hot CPI, I don't know how much strength this will actually have, because there's a lot of structural headwinds against the US dollar. What is interesting is just looking at the euro. The euro continues to look, to be honest, quite strong. And it looks as though it's facing a little bit of resistance at 115 or so. But the reality is here that the euro at the moment is supported. The ECB is not going to be cutting too much more, as we just mentioned. It looks as though the economy in Europe is relatively, not ripping, but relatively solid. We have infrastructure spending coming, more spending on defense everywhere. Services sectors, it continues to hold up quite well. So it could just be that the euro here, you want to be buying it maybe down at about 112, and maybe, I don't know, selling, but lightening up at sort of 115. That seems to be the range. What is interesting is, again, that's going to be sort of dependent on the CPI for the next moves. Something I'm looking at as well is the Euro JPY. This does seem to be in a bit of a breakout pattern potentially here. You just look here on the daily chart, you can see that this very key sort of got this sort of box here, this pink box, this lilac box. You see here about 165. This is a pretty key level. There's been a lot of resistance. If this continues to break out, continues to push up, I think this could break up and definitely sort of push up to 166, or maybe even a little bit higher. There's still sort of trade negotiations going on between the US and Japan at the moment. So it's not any clarity. The Japanese seem to be fairly insistent. They continue to call for all tariffs to be removed by the Americans. So I don't think it's going to be, the point is that I don't think there's going to be a very quick resolution to that. And I think it's going to be a bit more of a protracted, drawn out sort of scenario. So I think the Japanese yen at this point is going to find it difficult to show, genuine kind of strength, which is not to say it's going to be weak. Okay, guys, so let's just continue and look over at, let's say, the general commodities. So I'm just going to put that on the GSG, which I like to look for as just a general, whoops. Let's go back to this one, put it up, GSG. So that actually showed a little bit of life this week, and possibly that was on the back of oil. And you can see here this trade range I've been talking about. It's starting to push up a little bit higher. And, as long as the global economy stays reasonably solid and, inflation remains, it's relatively sticky in the US, but potentially going down elsewhere. And we saw, for example, in China overnight, inflation was lower. But it looks as though GSG is heading on its way up. That's something interesting to keep an eye out for there. Uh, just having a look at some of the other sort of commodities quickly. Oil is doing okay, breaking out a little. Well, I don't want to say breaking out, but sort of relatively solid this morning. It quite liked the jobs number. It likes the idea that trade deals, potentially could be done. It likes the idea of a softer US dollar. And it likes the idea of a little bit of inflation because, real assets such as sort of real commodities tend to do well in that kind of environment. On the other hand, if we just throw in a couple of moving averages here, you can see that we are getting up on the front on this continuous contract here to the 200-day moving average. No, sorry, the 100-day moving average, my apologies, which is also a bit of horizontal resistance. So that's probably going to be where oil wants to sort of see what's going on at 65.40-ish on the front contract. Again, not really any catalyst for a strong move upwards, but a lot of people are short. If you look at the speculators, there's a lot of short, sort of short positioning, and so it could be that some of this here just stops being broken. And if we do push above the 100-day moving average and this price here at 65.30, I do believe there's going to be some stops, and that could push, that could suddenly sort of spike higher, a bit of a short squeeze, maybe even up to 66 or 67 bucks. That's something to be looking at. If we just have a look over at some of the metals. Quickly, we look at gold. Let's look at the spot price of gold. Just giving back a little bit. Again, just that sort of positive news on Friday with your employment report. And gold here, it is interesting because it's had a very good, strong run up. And definitely you can still see all the moving averages. Still, the momentum is very much sort of towards the upside. But you have to say that the momentum is slowing slowly. If we look at this 20-day one, starting just to sort of flatten out just a tiny bit, just a tiny suggestion. There's still a lot of structural good reasons to be buying gold. We just saw over the weekend that the Chinese central bank, the People's Bank of China, is continuing to buy large amounts of bullion, gold bullion. So for sure, there's still a structural demand for gold. So maybe it's just taking a bit of a pause here. And, this possibly will be another sort of buy on dip at, 3,100 or something if it gets back down there. Copper in the US, just pausing. It went through this very key level, just coming back a little bit, having a bit of a pause. And we'll see, because last night in China, we had, as I said, deflationary figures. It looks as though the economy in China is okay. It's not weak, but it's not strong. It sort of seems to be okay, just looking at the inflation numbers and also other data, of course. So copper is holding in there relatively well, but some of this, as I've mentioned a few times last week, is because the high grade here trading out of the COMEX. There's some talk that Trump might actually at some point put a tariff on copper. So there is a little bit of a premium being paid for that. And again, this is just a little bit of a pullback, and it wouldn't surprise me if copper pushes up a little bit more. Finally, I just want to have a look at the equities. We know that the volatility is low. Volatility really, pretty low levels. Not historically low, down at 12 or 13 or something, but certainly compared to where it was over the last few months, we're now trading at between 17, 19 kind of handle. And although that base is a little higher than it has been historically, that's still a lot less than it was. So that's the good news here for equities. And if we look at something like the SPX, the cash index, you can see here that there's nothing bad to say. It's still grinding higher. Obviously, it's coming towards its recent highs. I would say that until and unless we get a close below, I'm thinking about 58. 60, 58, 65, something around about this level here. You can see this is a very important level, 58.65 on the cash. And until we get a close below there, there's nothing really negative to say about the SPX. At this point, my point is that even if it comes down, 20, 30, 40, 50 points, that's nothing. It really has to close below there, 58.65. To sort of start, getting interesting for the bears to maybe start pushing a bit further downwards. And if it cannot close down below there, the path of easiest travel is probably just to retest a little bit higher. And if you think about the CPI, if the CPI comes in a bit soft, that could mean, more Fed cuts coming sooner, which is not a bad thing for equities. And if the CPI comes in, in line, or maybe even a tenth or so higher, that's not even necessarily a bad thing, because in sticky inflation environments, assets such as stocks tend to actually do much better than bonds, for example. Bonds will be the ones which will sell off on a higher than expected CPI, more so that I would say than the equity. So equity is doing just fine. Nasdaq, or look at the NDX. Nasdaq doing very well. And again, there's this whole sort of theme that sort of certain industries, especially like in the technology space, in defense, where defense and technology sort of have a nexus, and they're going to continue to do pretty well. And you can look at something like, I think it's called XAR. If we look at XAR, which now XAR is interesting because it's aerospace and defense, but that has a lot more of the like the drone technology rather than sort of old school fighter jets and whatnot. And look at this. This thing is absolutely sort of ripping higher, all-time highs. So my point being is that in the stock market, it's not really just a question of the indexes or the indices. There are certain sort of winners here. So you have things like the financials doing pretty well. You've got tech in general doing quite well, and you've got defense, especially where defense is at the cutting edge of technology, which you see a lot of in XAR. Some of these stocks are doing very, very, very well. We're also seeing ITA, another defense and aerospace stock fund ETF, doing pretty well. So I think it's a question of trying to pick some winners here. There's definitely rotation going on. So maybe it's really a question of not so much looking at ES of, the stock market will go down, but it could just be sort of internal. It looks like there's internal rotation happening more, and certain stocks in favor are being pushed higher and others are being sort of undervalued or valued down a little bit. That's the way I'd be looking at it. Okay, guys, I'll leave it there. I've spoken already too long. So let's keep an eye out from headlines from London on the sort of the US China sort of trade talks. Trump, no doubt, will be sort of tweeting about maybe a shadow sort of Fed chair and the trade talks. And I don't think there's any sort of market implications of what's happening in Los Angeles in terms of some of the sort of disturbances there. But what could be interesting is that if some of these disturbances and sort of manifestations against Trump's immigration policy start to spread elsewhere, I just wonder if eventually that could put a bit of pressure on that sort of strong immigration policy, and that would allow more immigrants maybe to stay in the country. Maybe more immigrants would be brought in, and of course that would mean a greater workforce, which of course would actually sort of push down wage pressure. So that's a little bit of stuff which could take sort of several weeks or several months. But the way I'd be looking at from a market perspective is through the lens of sort of one of the big things which has happened under Trump has been almost complete halt to immigration and obviously some active deportations. And that tends to sort of lower the available pool of workers, which is pushing up the sort of labor cost. And a lot of people are also saying that there's some kind of substitution effect happening. I was reading some research over the weekend to the effect that a lot of with sort of some of these sort of immigrant workers not coming in and some of them actively being deported are sort of so-called native-born Americans are taking up that slack and taking over those jobs. And maybe that's sort of keeping the unemployment numbers sort of a bit more stable than otherwise they would have been, because those people tend to be generally a bit more sort of on the books and in the system. Just something to think about here is this nexus between immigration and immigration policy and the available pool of workers and such what. Okay, guys, I'm going to leave it there. That's it. So as I say, no particular data today. We've obviously got CPI on Wednesday. We'll be looking at that as we get closer to it. Have a great week and enjoy yourself. Thank you.